Right, we're going to have a look now at question 15 that came from the June 2021 paper 2, 7127-2. And this one is all on marginal costing. So it says here that UJW Electrical Limited produces washing machines. It has a new washing machine it wants to launch from the 1st of August 2021. So this is all in advance, which will be produced in a new factory. Following options A and B are considered. So you can see here that factory B has a higher capacity. It also has a higher cost for annual factory rent. The factory manager's salary is going to be the same, 27,295 for both factories. But because of the higher capacity for factory B, we're going to need one extra member of factory staff. It tells us that the selling price for washing machines produced in factory A will be £750 each. Due to the economies of scale, the selling price of washing machines produced in factory B will be 10% lower. So factory B, this is A here, 750. Factory B is going to be 750 minus 10%, 75, which is going to be what, £675. So that's the selling price. Factory A, 750. Factory B, 675. Royalties must be paid to the designer of the washing machine at a fixed rate of £15.40. Well, that's going to be a variable cost. So royalties are a direct expense. That's going to be variable. If we don't make any washing machines, we don't pay any royalties. Each extra washing machine will incur a royalty fee of £15.40. And in case you don't know, royalties are just like a fee that's paid if somebody designs something and they have perhaps the copyright for that. We pay them an amount per unit in order to use their design. Factory staff are paid a monthly salary of £1,475. So that's monthly. Okay. Each completed washing machine incurs an additional labour cost of £20. So again, that is going to be a variable cost, whereas the factory staff paid a monthly salary are going to be a fixed cost. Materials of a higher quality are needed for the new product and are likely to cost 40% more per washing machine. The current costs are £177.40. So let's work out what that would be then. 177 add on 40% is going to be £248.36 per washing machine. Okay, so the first thing we're being asked to do then is calculate the break-even point in units if 1,450 units are produced using factory A. Okay, so what we need to do first of all is work out the contribution per unit, per washing machine in this case, which is the selling price. Factory A selling price is £750 minus the variable costs. Now the variable costs are going to be £248.36. Let's put that in the calculator. It's already in the calculator, handily enough. £248.36 plus the £20. So plus £20. So variable cost. Let me just write this down as we go along. £248.36 plus £20. I think that's probably about it, isn't it? So 200 and... Oh, and hang on. No, we've got... There was something else, wasn't there? What else were we having to... Oh, the royalties, of course. Nearly forgot the royalties, having waffled on about them. £15.40 of royalties. So 248.36 plus 20 plus 15.40 is variable costs of 283.76. Therefore, contribution per unit is going to be the difference between the 750 and the variable cost. It's going to be £466.24. Now, to find the break-even point, it's fixed costs divided by contribution per unit. Now, fixed costs. Let's have a look at the fixed costs. So the fixed costs we had rent. Annual factory rent for factory A is £38,000. We've got the factory manager. So that's rent. Factory manager, 27,295. That's that one. And then we've got the salaries of the staff. So the salaries, don't forget they were paid monthly. We've got 4 of them. So 4 lots of 1,475 times 12 months is 70,800 in salaries. Okay, so let's add that to the manager's salary and the rent. So that means that our fixed costs are £136,095. So if we do break-even point, fixed costs 136,095 divided by the contribution per unit, which was up here, 466.24, divided by 466.24. That tells us that we need to make 291.89902 washing machines. Well, we can't make 0.899 of a washing machine. We always need to round it up to the next whole unit. So we need to make 292 washing machines in order to break even. So 15.2 then, we've been asked to prepare a marginal costing statement to show the revenue, the contribution and profit if 2,000 units are produced and sold using factory B. So remember that marginal costing generally assumes that everything we make is sold, so we don't carry any levels of closing inventory. So the first thing we're going to need to start with then is sales. If you remember, we calculated the selling price here and the capacity was 2,000 units. So let's stick the sales in at the top. It's 2,000 washing machines at a selling price of £675. So that was 10% less, wasn't it? 2,000 times 675 is a total sales figure of £1,350,000. Okay, then we've got to look at our variable costs. So remember, with the marginal costing statement, we must make sure that we show clearly the contribution. So we need to take the variable costs off first of all. Okay, so variable costs, we're going to have some materials. Remember, we worked out that they were going to be 200, let's put that side by side, 248.36. So 248.36 times 2,000, 248.36 times 2,000 is 496,720. Then we're going to have the labour. So remember, not the factory staff, but just this £20 per unit. So £20 times 2,000, which is going to be 40,000. Don't need a calculator for that one. And then we've got the royalties. Remember, we're paying the designer of these washing machines £15.40 per washing machine times 2,000. So we're going to be paying that designer a total of £30,800. Okay, so that's all the variable costs. If we add those up, 40,000 plus the 496,720, so we've got a total of 567,520. And if we take one away from the other, we don't get gross profit. Remember, we're looking for contribution because it's marginal costing. So this is the contribution that's going to go first of all towards the overheads, the fixed costs, and then once they're covered, it will be profit all the way. So the contribution in this case is going to be 782,480. Okay, so then we can take the fixed costs off. So we worked all those out, didn't we, to do the, oh, actually these were for factory A. Let's be careful here. We didn't. So we've got the rent, which is a total, oh, I've got that clip there in the way. The rent was a total of £42,000. We've got the manager's salary, which was 27,295. And then this time we've got staff, which is going to be 5 of them, and they're each paid 1,475, but that's per month, so times that by 12. 5 times 1,475 times 12, because we're doing this for a year, is 88,500. So let's add those fixed costs up, is 157,795. And if we take that away from the contribution, that's going to give us the budgeted profit for the year, which is 624,685. Okay, so 15.3 then, the directors of UJW Limited have reviewed the results for both options, Factory A and Factory B. One director raised some issues with using break-even analysis as a decision-making tool. Okay, assess the usefulness of break-even analysis in deciding which factory to open. So what we have to do here is assess the pros and the cons, the advantages and the disadvantages of using break-even analysis, and indeed marginal costing, in making the decisions. Okay, so it's good for decision making, for what if calculations, so comparing factory A with factory B, for example, and seeing which one has perhaps the lower break-even point, the greater margin of safety, that kind of thing, which one will give us the highest level of profit if we do the marginal costing statement. And we can do things like a break-even graph, so that would be helpful in supporting an application for finance. Disadvantages with it, though, it is a little bit simplistic. It assumes that everything we make can be sold. Obviously, it's very much dependent upon our forecast being accurate. So are the costs that we've forecasts, are they accurate? Is the level of demand accurate? So there's one of the problems with management accounting. It is all based on estimates. So there's no guarantee that we will achieve 2,000 units of sales, or that the salaries will remain as we forecast. It also assumes that costs behave in a completely linear fashion. So if we plot them on a break-even graph, everything behaves in a straight line. Well, again, in real life, that's probably not going to be the case. Fixed costs may be stepped at a particular level. So we would need to take that into account. And actually, we may achieve greater economies of scale the more we make of something. So raw materials may become cheaper and our workforce may become more efficient. And the other thing about this is it ignores, what does it ignore? Qualitative data and also external factors. So, the current state of the economy, that kind of thing. But we probably don't want to be getting into too much depth. We want 6 marks here. So we just need to thoroughly weigh up the pros and cons within really that amount of space. We don't need to write any more. Anyway, hopefully that's given you some ideas. Thanks very much for watching. Don't forget to like and subscribe if you've enjoyed the video.